Good afternoon. Welcome. Thank you for coming. My name is Simone Cavallaro, and I'm the director of the Stigler Center here at Booth. We're excited to host Sharon Bowen, former commissioner of the Commodity Futures Trading Commission, for a conversation with Booth professor Guy Rolnik on financial regulation and beyond. Thank you, Sharon and Guy, for joining us. I just want to remind you that we are on the record. We are live streaming the session, so please silence your phones. As always, I just want to remind you that the views expressed by individuals we host are their own, not those of the Stigler Center or the University of Chicago. As you may know, the Stigler Center promotes and diffuses research on regulatory capture, the various distortions that special interest groups impose on capitalism. We have many initiatives, so please check our website for full details. There is one particular initiative that I'd like to highlight. At the beginning of January, we released a new podcast, Capitalism, hosted by Stigler Center faculty director Luigi Zingales and Kate Waldock from Georgetown University, on what works and what doesn't in capitalism today. If you haven't already, please check it out and leave a review on Apple Podcasts. Back to today. We look forward to hearing from Sharon and Guy's insights. Before we begin, please allow me to briefly introduce our guests. Sharon Bowen has more than 35 years of regulatory security and public policy expertise. She recently joined the board of directors of the Intercontinental Exchange and serves on the boards of several NYSE exchanges. She served as a CFTC commissioner from 2014 to 2017. During that time, she was a sponsor of the CFTC Market Risk Advisory Committee. She was previously confirmed by the U.S. Senate and appointed by President Obama to serve as vice chair of the Security Investor Protection Corporation. Previously, she was a partner in the New York office, Latham & Watkins. Guy Rolnik is a clinical associate professor of strategic management here at Booth. He teaches classes on the political economy of regulation and the news media. Guy has 30 years experience in financial journalism and is credited with leading dramatic financial reforms in Israel. For the last few years, his work has been focused on dynamics of regulatory capture. Please join me in welcoming Sharon Bowen and Guy Rolnik.
Welcome, everybody. Welcome, Sharon.
Thank you.
Thank you for joining us this morning. So before we start and delve into financial regulation, I look here at the audience and I feel that some of the people here were still in high school when we had the financial crisis.
Right.
So if you don't mind, before we start, we are now sort of celebrating 10 years for the financial crisis. So perhaps to give some background and context before, tell us, try to go back 10 years ago, 2009 or end of 2008, beginning of 2009, where you were at this point in your career, and share with us your perception and your analysis of the crisis at this point, how shocking, devastating, surprising, threatening this was. Please.
Yes. So at the time, I was a corporate partner at Latham & Watkins in New York, and a number of the investment banks were obviously clients of our firm. The weekend before the big meltdown, I was starting to get emails from a group of friends, people in the industry, etc., seeing things like, don't be surprised if you see crazy numbers with the valuations of some of the investment banks at like $2, $4 a share, or, there's a rumor that this bank may be out of business the next day. There were a lot of rumors circulating that weekend. And so that morning, as we kind of watched the meltdown, if you will, It was a pretty scary day. I mean, we didn't, as you can imagine, being in a major law firm representing major clients, no one really knew who was really affected. There were a lot of rumors that pretty much half of the investment banking industry was going to be going under. As you do know, Lehman Brothers did go under. That was the day when you actually did see people packing up their offices with boxes and moving out. As a result of the financial crisis, there were a lot of layoffs on Wall Street. The financial services industry, the legal profession, a lot of people lost their jobs. And in addition, a lot of people lost their savings, their retirement accounts. I have family members and friends who lost their homes as a result of the crisis. And so it had pretty long-ranging effects on everybody from Wall Street to Main Street. And frankly, it created such a devastating hole and lack of confidence in the market that it really has taken us a long time to instill the confidence back in the marketplace and to, as you know, we had to put a lot of regulations in place with Dodd-Frank.
We'll talk about that, yeah.
As well. But it was pretty scary back then.
So at that point, how did you see when you were looking for culprits, what was your analysis at that point in 2009 and today? Did you see it as a regulatory failure, or maybe, financial crises have to happen every 70, 80 years?
I think it was a miscall in some respects. I think there was the misperception that the so-called dog pools, the over-the-counter markets, were between sophisticated players, between sophisticated investment banks. And I think, one of the commissioners at the CFTC, Bowen, had warned the market that she thought these sort of esoteric derivatives products should be regulated. But the prevailing view, I think, at the Treasury and the Fed, the other prudential regulators, was that these are big boys; they can regulate themselves. Obviously, what happened was that turned out not to be the case, and there were a number of products, particularly the credit default swaps that AIG in particular held, where a number of the counterparties happened to be the very major banks, and so it became somewhat of a cascading effect, if you will, but it was clearly a market that was not regulated before. There was the perception that it was a market where people were sophisticated enough to know what they were doing. Yeah. And that turned out, frankly, not to be the case.
So you mentioned Bruce Bowen, the chair of the CFTC. So I believe it was Professor Simon Johnson from MIT that named the book that he penned with James Quack, 13 Bankers. And 13, when he was referring to the financial crisis, and 13 Bankers, for the benefit of the audience, was a takeoff on an anecdote that at some point in 1999, Undersecretary at that time, Deputy Secretary of Treasury at that time, Larry Summers, called Brooks Bowen during a meeting with bankers and said, I have 13 bankers in the room right now, all saying that if we regulate derivatives as you want, this will risk either financial collapse or stifle financial innovation. And the question is, do you agree with this narrative that the decision by Congress in the late 90s not to regulate derivatives, decision that was lobbied by Rubin and Summers, had a lot to do with the financial crisis that we had in 2008?
Obviously, with hindsight, we can all look back and say that was not a good decision at the time. I think, part is, in fact, the markets were dark. We, in fact, did not know the magnitude of what was out there and who the counterparties were. So when I say it was an opaque, dark market, it really was. And when that market cratered, it had a cascading effect that influenced and, frankly, contaminated not just the financial system, but people's livelihoods. So in hindsight, yes, they didn't get it right.
Yeah. So what has changed for the good or for the worse since 2009? Or put in other words, do you think that the financial regulators, be it the SEC or the CFTC, today are less beholden to the financial industry interests?
Well, that's two big questions you just asked.
Okay.
I'm going to start with the easier one. Let me just say, in terms of the market today. I mean, there's no doubt that we are much better protected today than we were in 2009, 2008, and that particularly with the adoption of Dodd-Frank, which gave extraordinary powers to the Commodity Futures Trading Commission, the agency where I was a commissioner, to bring light to these dark markets that we talked about. And so it was a global crisis. And so in 2009, the G20 leaders met in Pittsburgh and decided to address the financial crisis. And again, it was not, it was a recognition that these markets don't have a boundary. And it is a global problem. And so from that, we were, I think, one of the first movers in adopting Dodd-Frank and creating some pretty good rules, I think, that are doing us well today, with the mandate for clearing. I mean, the first thing is to bring transparency to the market. So, to require that all standardized swaps be traded on an exchange. And, basically to have reporting obligations, which we didn't have before. So we could collect data to see who was holding what positions. And then for swaps that weren't clear, to make sure that those were reported and were subject to extra collateral and margin. So basically we set up a whole new system of trading and clearing these products that became transparent with clearinghouses that attempted to mitigate the risk of one party defaulting. And with that being backed by collateral to support the transaction. Before that, you had two parties, counterparties trading with each other, trusting the other person's credit with nothing to back it up. So this was a great tool to mitigate those risks.
All right. So just before, like 2 hours ago, as I was going through the website of the Financial Times, came up a news story. I just updated to you that Paul Tucker, the chair of the Systemic Risk Council, which is a U.S. think tank. Tucker was the deputy governor of the Central Bank of the UK, but this is an American think tank, and they came out with a report that asserted that the U.S. government's focus, and I'm quoting, on the resilience of banks rather than markets, which they operate, risks significant gaps in supervision that could cause another calamity. What do you think?
That's a big statement. I haven't seen the report. I look forward to reading it, and I know that's an excellent think tank with some really, really great minds. I think what they may be talking about, or at least one of my fears has always been that, we were solving for the 2008-2009 problem.
And now we have new problems.
And now we have new problems. And I was always concerned as a commissioner that we not lose sight of the new risk that could be in front of us. And, particularly, that there is some concern that our central clearing parties, our CCPs that we created, are themselves now subject to systemic risk, such that all the risk is concentrated in the hands of just a few. And then, what would happen if there's not sufficient collateral? And that's a good question. And so we have to make sure that these institutions are risk managed appropriately, to make sure there is sufficient collateral, and we make sure that they undergo stress testing to go through scenarios as if a major disaster were to happen. If they would have sufficient margin to cover their position. So I think what they're saying is that, yes, our banks may be stronger, but our financial markets is a little bit
Yeah, I think they
awry.
mentioned also clearinghouses specifically in the report. I haven't read the report.
Yeah.
So I think it's Warren Buffett that actually says that derivatives are weapons of mass destruction. So how does it feel to be a regulator that regulates weapons of mass destruction? Okay.
Well, we definitely made it simpler. That's for sure. We kind of unpacked what was there. You kind of think about these esoteric transactions. We kind of sliced and diced, say, a portfolio of loans and put them in a bundle, and then sliced and diced them again, and we gave them different ratings based on who got paid first. So, whether they got an A rating or a D rating. And then we sold, off that tranche, if you will, the securities. Well, people forgot to look at the underlying loans to see whether they were worth anything. And so the ownership of the underlying loans, it didn't really matter to, that other party who bought the security, because they were buying the security, not the loans. And so you could kind of see how that problem cascaded, like how many times can you slice and dice an asset and resell it and repackage it without having the underlying value really be there.
So is it that people forgot not to look at the underlying assets, or we had a situation where there were enough incentives to look at the underlying?
That's a good question. Some people would say that it was the housing crisis and the having people take out mortgages they couldn't afford. There are lots of theories as to what happened back then.
Okay, so we are at the Stigler Center, and we're very interested in the question of captured regulation. Now, when you look at the literature on captured regulation, most of the time we talk about 4 or 5 dynamics that lead to regulation being beholden to special interests, and one is asymmetric information. The other one is access on complexity, that you have to rely on the industry. Of course, we have revolving doors, and sometimes we even have social capture or cultural capture, and the obvious one being the money and politics. So when you look, you have a lot of experience now. You came from industry and then to regulation. What do you think is the saliency of each of those mechanism when we look at regulatory capture?
I can understand the concern, and I think there are some good tools that are in place to guard against that. For example, at my former agency, 5 commissioners, bipartisan, the 3 commissioners of the party of whichever office is in the presidency at the time, and the chairman being selected by the president at the time. That's a public vetting process, meetings with senators, public hearings, kind of scrutinized, as you can imagine. You sign ethics obligations even once you become a commissioner in terms of you can't accept gifts, people can't take you out to lunch, all kinds of ethics obligations as well. So it's part of that process. And then once you're in the commission, the Administrative Procedure Act, which is how rulemaking is done, requires us to put out for public notice and comment any proposed rules or regulation. In addition, our agency was known for having a number of public roundtables to vet questions. I always get asked the question, were there lobbyists coming to see you all the time? Yes, there were lobbyists who came to see me all the time.
And you took their calls.
Well,
you took their meetings.
Well, not only that, but there's a record of every meeting we had, that every commissioner had. That's public information. But we also made sure that our advisory committees were made up of the public interest and buy side, sell side, academics. We wanted to make sure we had a diverse group of perspectives, if you will. And for the most part, we want our markets to be transparent, fair, balanced. So there isn't a Democratic answer and a Republican one.
Give us both.
Yeah, it's what's the best answer? Mm-hmm. And that's really what we're trying to achieve. And I think during the time I was a commissioner, 99, 95% or a high percentage of our decisions were unanimous. And so we always would strive to have a consensus as well. So there's not this sense, I think people think that it's a lot more partisan than is the case. At least that was not the case, or my experience in my agency.
So you mentioned the Procedures Act and public notice. So when you go out with a new piece of legislation or regulation or whatever, and so how many of the people that wanted to talk to you, wanted to voice their concern or had comments were industry? How many of them academics, and how many of them like from the dispersed public?
Yeah. So typically what would happen is most of the industries will do a letter through a trade association. So it could be like, 30 in an industry through one trade association. Either that or they'll send 30 of the same letter. You would definitely have public interest groups that would likewise would send in comment letters. And sometimes you would have academics, not so much academics, but it tended to be people who were affected by the rulemaking who would send in comment letters.
Okay. So I want to build on these questions of capture. So correct me if I'm wrong. So the average salary compensation package of a director in a regulatory agency would probably be something like 5% of the executives in the industry that he regulates. Now, this huge gap, does it have any influence on the questions that we're raising here today of regulatory capture? When we know where, your career path is 5% in government and 100% in industry?
Right. Well, it kind of goes both ways. I mean, it's, I think the three of us, when we were confirmed at the time, then Chairman Massett and now Chairman John Call and I, we were confirmed at the same time. And we did have Wall Street backgrounds. But all of us were pretty much, I retired from my law firm to be able to take this job. And so it wasn't with a view towards, I did sign up for $155,000 to think that I'm going to get paid more money. We had pretty good resumes and backgrounds to begin with. But there's a lot to be said with having people with the expertise to come in to regulate the markets, who are motivated not by money. And I think that kind of comes out in the vetting process, and also, frankly, during the confirmation hearings in terms of like who's why you're interested in doing these positions. For me personally, I had already sort of built a history of being very much interested in protecting the investor from my being acting chair and vice chair of SIPC, the Securities Investor Protection Corporation, at a time of the Lehman Brothers bankruptcy and the Madoffs and the MF Globals, having seen the devastating effects. So, when I walked in the door, I made it clear that, and as I did during my confirmation hearings, my role as commissioner is to look through the lens of those who really got affected by the financial crisis and those who normally would not have a seat at the table. And it was through that lens I always viewed all of my decision making.
When you were appointed, did you make a decision at that point that after you finish your term, you are not going back to Wall Street? Or is it something that you decided recently?
No.
No, you knew that's the end of it?
Yeah, I retired.
You retired?
Yeah, I did retire.
Okay, early retirement.
Yeah.
I see.
Well, not that early, but...
Take it as a compliment.
I was able to retire, let's put it that way.
Okay, so you did mention...
You have to remember, law firm partners don't last that long. No. Okay. Just joking.
Okay. So you mentioned Dodd-Frank, so I don't want to go into the details, but just when we look at Dodd-Frank at this stage today, 2018, what do you think are the most important parts of this huge piece of legislation that should reassure us, the people here in this room, that we've made progress since 2009?
Well, I think that the transparency is the key. I think that having the dark pools there really, by definition, meant we didn't know what was behind those doors and what could hit us. So I think the transparency that these rules require makes a big difference. I think the higher capital requirements and margin requirements we make sure that sort of two things, that the financial institutions are healthy enough to be invested in these kinds of markets. And two, that the margin is sufficient enough to make sure that the customer money was protected. Because at the time, customer money was not protected. And so, with margin and having sufficient collateral, you can be assured that your money's been taken care of. And then one other step, which is the case with not all accounts yet, although I'm hoping the Fed will get there, is that to make sure that the cash customer accounts are held at a Federal Reserve Bank, so that you know where your money is and that it's safe. Because right now these CCPs hold an enormous amount of cash collateral, and I want to make sure that if we were to have another crisis, heaven forbid, that the customer money is protected.
Mm-hmm. I know it's not the responsibility of the CFTC, but you must have been following the deliberation around another rule that has to do with retail investors in this case, and this is the Fiduciary Rule. The Obama administration was working on it for 6 or 7 years, mm-hmm. and now this administration wants to repeal it. Do you have any position on that?
Well, my personal opinion, anything we can do to level the playing field to make sure that the everyday investor is getting the best possible advice, I'm for. Mm-hmm. I'm definitely for.
Okay. So another quote, not from this morning, but from last week, Bloomberg Business Week analysis asserted that 10 years after the crisis, banks wing big in Trump's Washington. Do you agree?
I disagree with that. I don't think we see that huge rollback. I don't think there's been a number done on Dodd-Frank, if you will. I think there are some tweaks around the edges. I think the Volcker Rule we may see some changes there. At my agency, I think all the commissioners who are there have made it clear that there's no intention to roll back Dodd-Frank, at least in the derivatives markets. It doesn't mean we can't make our rules better. It doesn't mean we can't simplify them and get rid of, duplication. But also, we need to be competitive in a global marketplace as well. And I think if you were to ask the average banker today, who may complain about the cost of complying with regulation, but they would tell you that, yes, our markets are safer and better protected today. And our markets are the envy of the world because of that it does give us, in fact, a competitive advantage because that's the case. You want a strong market that people are attracted to. You don't want there to be sort of a race to the bottom. And so, I think in that sense, we're in a pretty good space.
One of the reasons sometimes people raise for some of the failures in regulation were some conflicts or turf wars between financial regulators, be it the SEC and the CFTC or other agencies. Do you still see that, or this is just something of the past?
It's really funny. So I had always assumed before I became a regulator that they all sat around the table together and talked about the markets and knew what was happening in each other's markets. And that really historically had not been the case, which is really quite interesting. So I thought, no wonder we had a crisis. They weren't even talking to each other, didn't know what was happening in the markets. That is less true today. There's much greater cooperation. I think FSOC has really functioned quite well in that respect, where you've got the heads of the CFTC, the SEC, the Treasury, the Fed, et cetera, at the table. I think really does make a difference in harmonization. We went out of our way, we commissioners of the CFTC, to have relationships with the SEC commissioners. Our staffs talk to each other daily. The market participants are pretty much the same, and they are doing transactions across asset classes. So it's important that we, in fact, do share information. And, frankly, in areas like enforcement, I think, having two sets of eyes on the marketplace, or three in some cases, is not a bad idea. But I think the turf war thing it's not the way it used to be.
Okay. If we go back 10 years ago, one of the reasons people raised for the crisis is, of course, the too big to fail, and specifically the concentration in the financial industry. But actually, when we look at the financial industry today, I believe it's even more concentrated than it was in 2008. Should we be worried? Should we be doing something about it?
I think some of the things we've done, and which is why some of the people are complaining, is by requiring the higher capital rules. You can go to one extreme. I mean, some people are calling for Glass-Steagall to come back into play, which I don't see that really kind of happening anytime soon. But I do think...
I think it was both in the Democratic platform, in the Republican platform at that point 2 years ago.
Yeah, I know.
Well,
hasn't
but
happened.
It's not...
Yeah, it hasn't
okay.
happened. Yeah, maybe it'll happen. I mean, don't bet on the market based on what I say, for sure. But it's the financial market's sort of a tricky thing. It's not like you can change it on a dime like that. But I do think with their capital rules especially, and having banks do the living wills, having them go through the steps of what happens in a liquidation scenario. You have to remember there was no preparation for if things go bad. Let's make you stronger. By making sure you have sufficient capital. But two, let's make you go through these drills so you can stress test if there were a bad scenario. And this is with doing this with evolving technology, the threat of a cyber attack, political events that could happen at the time, and making sure that these institutions are prepared for that. I mean, something as simple as knowing who to call. Like people, before didn't even know who to call up. Like, who do you call first? So even just having a harassment, like, who do you call first? For example, you have a cyber attack. Who's going to fix the problem? Who's going to call the CEO? What are you going to tell your stockholders? And what are you going to say to your customer and consumers? So you need to think things out before bad things happen. So I think that's one of the lessons that we learned, unfortunately, by going through a bad thing, if you will.
How big is the risk that the next financial crisis will be cyber attack?
I worry about cyber. I really do. It's everywhere. I mean, as we know, it's everywhere. And so we have to be really to make sure that we're doing all that we can to protect the integrity of our markets, and we do. I mean, we have regulations, system safeguard protections in place. We do oversee our financial markets to make sure that they have the proper procedures in place. But our markets are interconnected, and so we have to make sure that your third-party vendors, whether it's your accounting firm, your law firm, your payroll person, people who may touch your systems are vulnerable. The people who walk in your door every day, your employees, making sure they're drilled and know how to deal with phishing and the different kinds of ways that the people can penetrate. And because it's a global open source system out there, that's something I think all of us worry about.
So I have a couple of, before we go into the Q&A, I think I would guess that 50% of the audience here, and this is based on my students, want to know your positions on blockchain and Bitcoin. So, so I'll start with a few provocative comments. So Nobel laureate Paul Krugman wrote in the Times last month that Bitcoin is a bubble and a fraud. His friend, another Nobel laureate, Joe Stiglitz, said we should regulate or outlaw. Jamie Dimon, the CEO of JP Morgan Chase, first attacked and then reversed, and maybe reversed again. So where do you stand on this debate of cryptocurrencies? Is it a bubble or the revolution that will, in a decade, totally disrupt and change the entire industry?
Well, first, my former agency declared Bitcoin and virtual currencies to be a commodity, so therefore regulated. And the CFTC has been quite proactive in some enforcement actions against individuals who are out soliciting individuals to invest in some of these cryptocurrencies. Similarly, two of the exchanges, the CME and the CBOE, have products that futures tied to the virtual currencies. Having said that, I think there's something like, I don't know, 1,300, 1,400 virtual currencies that are out there. And so no one's really regulating the cash or spot market. And that's the concern with the retail investor, which is why you see all of the joint announcements with the SEC and the CFTC, particularly with people trying to raise funds through these initial coin offerings. I think the regulators are doing the right thing. I think they are, right now is a really small percentage of our markets. I think they're taking it seriously in terms of not yet a threat, but maybe could become a threat. Clearly from the investor protection, the CFTC and SEC has made clear we're going to go after you if you're using this to scam retail investors. So I think that's the right way to deal with it at the same time without stifling the potential benefits that may come from the blockchain ledger, for example, as opposed to separate that from the virtual currencies, if you will. I think some people see some use in that in terms of payment systems and settlement, shortening the position. It could help with reporting. It could help us regulators, frankly, oversee the markets in much more real-time fashion. So I think there's some promise. And so I think you see, fintech labs. My former agency started a CFTC lab to learn more about fintech and the industry. We have MOUs, memorandum of understanding between us and other governments outside of the U.S. to share information, because again, this is a global phenomena. At the same time, so I think the approach right now is caution is good, without stifling innovation.
Mm-hmm. So when you were still at the agency and you engaged with the financial institution, do you think that they perceived the cryptocurrencies as a threat to their business model or an opportunity to, blockchain can streamline their business, reduce costs dramatically, and so on?
Well, I see most of them investing in them.
Okay.
That says something.
To co-opt them or
I don't know. I don't know. It could go both ways, right?
Okay.
So I think some of the.
Did you see the financial industry lobbying to have more regulation on cryptocurrencies to make sure that they do not pose real competition?
No, not in that sense. I think the only thing I did see was that the industry was a little bit critical of the certification of the futures products that came out of CPO and CME. They had thought that a little bit more public comment and notice on those two contracts should have been warranted. And I do think the agency responded in saying that there's going to be sort of heightened security and looking, or scrutiny rather, heightened scrutiny and looking at those kinds of products, in that sense.
So one last question before we go to the Q&A, something that we chatted just before with it. So can you describe the relationship between the regulatory agencies, the news media, how news media influences regulators and the other way around, or the industry?
Yeah, people read, we read papers, as you know. I think a lot of the news around the flash crash and the Mike Lewis book and all that, and the formation now of the IEX exchange resulted from that. People are quite interested in it as well. I think the Bitcoin mania is, a lot of it is a media sensation than necessarily a real economic reality in that sense. So, I think there's a lot. People read, the technology is such that, you read about something, you don't want to be the last one, to be there. But, I think with the investment in things like Bitcoin, I think there really is a generational thing. Like, my peers and I have not invested, their kids are. So it's really different.
Yeah. So you reassure us that even in the next financial crisis, we can still blame the news media.
Exactly.
Okay.
That's exactly right.
Okay, so let's now take questions from the audience. I think we have some mics, please. Yes, please. Just a second, wait for the mic. Introduce yourself.
Hi, I'm Ashley. I'm a first year at Chicago booth. I previously worked at the Asia affiliate of SIFMA, so very familiar with trade associations.
Yeah.
I was just curious as to the role, just given Asia, like the role that sort of the global derivatives market played in the rulemaking for Dodd-Frank, and how closely the CFTC interfaces with global regulators in determining how its rules will affect other markets.
Yeah, that's a real good question. It took us a while. When I first joined the agency, we were trying to work with Europeans on an equivalence determination so that the European markets could solicit U.S. citizens and vice versa. And so the equivalence determination was finally reached after 4 years. But part of the problem was, well, the good news and the bad news is we were the first out there, if you will, with our rules. And they were pretty comprehensive, so we got a head start. And I think that some of it particularly rubbed some jurisdictions the wrong way. So it took us a couple of years, frankly, to kind of smooth or ruffle feathers to say, look, this is a global market. We need to come up with a system of recognition to make sure that we're respectful of each other's jurisdictions and how you decide you want to regulate your markets and how we want to regulate ours. So it's been a slow but a good progress, if you will. I think we're kind of in a good place. Having said that, I think Brexit and some of the fevers of nationalism has, called into question, whether people are going to retreat and be, more protective of their markets, and that we would take a step backwards. And I hope that that's not the case.
More questions? Until we have the next question, perhaps I will. Here we are. Sorry.
Hi, Alberto, second-year student and exchange student from HEC.
Can you raise your
Paris.
voice?
Yeah, sorry. Alberto, second-year student and exchange student from HEC Paris. I would like to ask your thoughts on two things. The first one is you touched upon a bit before about systemic risk, and in particular, neither Dodd-Frank, either Basel III addressed directly this point. Some propose to introduce a Pigouvian tax on it, some others to regulate in some other ways. I want to know a bit your thoughts about it. And the second point is on shadow banking. Thank you.
Well, those are two big questions, too.
Okay.
So I think the first question had more to do with the systemic risk question, and whether or not I thought Dodd-Frank had really addressed that. No, I think it's done a good job. I think the systemic risk is way better. That we've reduced it significantly with some of the things that we put into place. But having said that, I think we have to be in a position where we're sharing data globally across the world, because without that, we don't really have a global picture of our markets. And that's where we kind of have the risk. We just have pockets of it. And with some of the jurisdictions, there are privacy concerns that hinder their ability to share some information, et cetera, which are hurdles we need to kind of overcome. But I think with better data and data sharing, that we will do an even better job. Your second question was a little bit harder, which now kind of forgot what it was, but it had to do with
Shadow banking.
shadow banking. Well, the problem with shadow banking is you can't see it. So I'm sure it's happening right now. In fact, we know it's happening. The volatility that we saw even this month in February, what we saw, the volumes of the off-exchange transactions went down significantly, and people, went to the lit markets of the exchanges because there they could see the real prices. And so, the problem with, the shadow banking role is that there's no transparency. So you don't really know if you're getting the best price or not. And so, we have to try to have more incentives for people to want to bring all transactions on a lit exchange, because we know that with that you get more liquidity. We know with that means tighter bid-ask spreads with prices and better prices for investors.
Yes, please.
Hi, thank you so much for coming. I am the first year MPP student from China. And my question is, last week there is a really big Chinese insurance company called Anbang got acquired by Chinese government because there are some unregulated issues. And I want to ask you, what's your comment or position on that? Thank you.
So I don't know that specific. I won't be able to answer your questions specifically because I'm not familiar with that. But having met with regulators in Beijing a year or so ago, there's always a tension with, a lot of the companies are backed by the government, and some of the financial industries are, but yet they'd like to have a vibrant market. So I do know that there's a lot of work in place to try to rewrite their securities laws. There's a movement in place to try to open up the markets more for trading. The problem, and one of the issues I was discussing with them is the volatility that's inherent in the market. You've got to be patient. That's what market making is. And so, I think historically there may have been the tendency to pull away from the market if it got too volatile. But I see a lot of promise of those markets really opening up. But as to that specific transaction, I'm not familiar with that to make a comment on.
Hi, thank you for coming here. Hello. Hi. Well, thank you for coming here. My name is Jose. I'm a first-year Master of Public Policy student at Harris. And I was wondering, as was mentioned here, about the mortgage crisis in 2008 and how that was came and surprised kind of all the market. How do you see now the student debt system right now, and how is the regulation arranging around it?
Did you say student debt?
Student debt.
Oh, that's a good one.
Yeah. I think some people are concerned about that.
I guess tuition's pretty high here, right?
Market rates.
Are you guys monetizing these kids' debt? I mean, what are you doing here? Are you packaging them up and making them into some securities I don't know about that should be regulated, maybe? Sorry, I don't know how to answer the question then. Unless, are you guys doing that? Hopefully you're not doing that right. They're not doing that right. No. Yeah, it should be fine, I'm sure. You're at a good school, so. Just pay your debts. Yes.
I think you can answer this one. So you mentioned that you find that your heart and your colleagues' heart are in the right places, that you actually do want to do good. And I sincerely believe that. Sorry, I should start. My name is Nicole. I'm from Singapore, and I have some regulatory background. Mm-hmm. And I sincerely believe that because that's what I saw in myself and my coworkers. But sometimes when you have to make difficult decisions, people doubt you anyway. So what do you think as a regulator? How should we engage the public more and convince them that we do have their interests at heart?
Yeah, that's a really good question. And, I think part of it, we don't advertise enough what we do every day. I mean, it's the tendency, again, for the media only to talk about things that go bad, but we don't talk about all the good days and the ways that we are protecting the markets and that we are overseeing your markets every day, every hour. The exchanges themselves have their own surveillance mechanisms and their own independent, regulatory oversight committees overlooking the markets. So we don't really advertise that to the public, the extent to which we are looking at your markets, we're making sure that they're safe, trying to protect against manipulation, excessive speculation, and that's there are thousands of people that are employed, and that's their job to do that. So wish we could get that out more. On the investor education part, I've always thought we could do a better job there too as well, because I think the first line of protection is educated investor. So you'll be less susceptible. You'd be surprised how many enforcement actions involved, the little schemes to help someone get rich, and the people are usually elderly, people part of the bingo crowd or people from people's churches, sometimes family members. I mean, when I read some of the enforcement actions and the facts of the people who are defrauded, it's just amazing. So we could probably do a little bit more. I had always, coming from New York, had always said if we had something like if you see something, say something like that in the financial services space. So if you know your grandparents or your parents are getting phone calls about something that doesn't sound right, then it probably isn't right. And they should kind of reach out to say, I got this phone call. It doesn't sound right, so.
Hi, my name is Leo. I'm a second-year student here at Booth. When talking about cryptocurrency regulation earlier, you mentioned that regulators are trying to be proactive. So I was curious, how do you, considering that a lot of these are new to world financial products, how do regulators try to stay ahead of the curve?
Yeah, I think, again, by looking at the markets like everybody else. I mean, it's we're in that marketplace too, making sure that people are protected. Even more so, I think, because it's gotten so much publicity as well. We're on the internet as well. So going to the places where people, are creating these false impressions of security in these investments. It's hard work, but we're in those spaces too.
Hi, I'm Drew. I'm a second-year MBA student. Kind of a different question, but for U.S. regulators internally, like rank and file, not senior leadership, if you have a career in regulation, what tends to be the basis for deciding who's getting promoted? How do regulators kind of grade themselves? I'm just wondering, when you're in this role, when so much of what you do is about preventing bad things from happening, how do you sort of measure performance?
Yeah, I would say, and it's interesting. I don't think it's that different from the way we did it in law firms. So it tends to be on the quality of your product and how hard you work at it. You may define results in different ways. But I don't think sort of that this, getting strong skill sets, being relevant, up to date and current, being able to communicate well, write well. I think the same skill sets that will help you succeed as a young associate would be the same skill sets that would help you succeed as a young regulator. I think they're the same.
Hi, thank you so much for coming out. My name is Ryan. I'm a first-year MPP student. And my question is, as you see more and more machine learning and more computerization of trading and buying and selling, how do you regulate that process when it's not so much humans handling it, but more a computer algorithm determining what actions to take?
It's a really good question. And I always grapple with this whole question of what's a U.S. person for regulatory purposes when in fact the transactions are happening vis-a-vis computer to computer. I think we will see definitions evolve. I mean, we had a proposed regulation on automated trading that didn't go through even with a supplemental proposal, to at least at the first instance to make sure that we had sort of pre-trade controls in place. But you're right. One, we have to have the technology to even be ahead of the curve, so that's really important. Two, how do you even define it? Who's the automated trader there? Is it the person who sets the program or pushes the button, or is it? Those are going to be evolving. Really, frankly, fun concepts. It'll be your generation figuring that.
So let me build on that and ask you, do you envision a situation where people can hide behind those algorithm machines when you talk about manipulation, fraud, cornering securities, and that this is the algorithm? I don't know, we programmed it, but, this is the algorithm. We didn't program it to manipulate stocks, but this was the outcome.
Yeah, we've taken some of those people to court. It's called spoofing. Yeah, we got a name for that. No, absolutely. It's called spoofing. That's illegal.
Okay.
Yeah.
More questions? We didn't discuss here today. I know it's not CFTC issue, but it's now on the agenda. The asset management, and some people are now calling for stress tests for asset managers, and specifically because there is so much consolidation now in this industry with the index funds and everything. We have like the BlackRocks of the world controlling vast amount of the asset management. Should we be worried about systemic risk when we talk about also asset managers?
I think people are asking the right questions. I'm not in that space, and asset managers have their own fiduciary obligations as well that are pretty well managed, and they definitely do stress test management as well. So I'm not really conversant enough to say whether that's the case. Other than to say, I think people are asking the right questions.
Okay. More questions before we end? Yeah, right here, and this will be the last one.
Hi. Hello. Hi. My name is Catherine. I'm a master's student in the econ department here. I spent a number of years working at an investment bank and then at a hedge fund before coming here. And I'm just personally curious, can you speak to some of your sort of most rewarding experiences that you've had in your career, either in private practices or as a regulator? Just some stories to share for the rest of us here.
Right. Wow, there have been so many. I've just been fortunate that I've really loved the practice of law. And it's just been like, for me, I think a great career for me because I have an MBA as well. So you can use your MBA too, guys. I think what I would say is just, remain curious. I have a curiosity that leads me to learn about different things. And so because technology changes so quickly, I would just sort of encourage you just to continue to be curious. So like now I'm learning all I can about blockchain and Bitcoin and cryptocurrencies because that's sort of the next thing, and nobody else is an expert, so I figured I might as well learn to become an expert at it too, since it's so new. I would say probably, being able to, one, develop really good skill sets that you can put to good use. Doing a good job for whoever you work for is one way to do that. At some point in your career, if you can give back in terms of public service, I'm a big proponent and encouraging people to do public service at some point in your career. I think it's extremely rewarding. And it has been for me, and I just had no idea that would be the case to the extent it has been. So,
Sharon, thank you very much.
All right, thank you, guys.